guys, today I want to talk about something that might sting a little, but in a good way. I want to talk about how real estate investors accidentally overpay tens of thousands of dollars in taxes, even they have already a CPA. And before anyone gets defensive, this is not about bashing tax preparers. Filing a tax return and doing proactive tax planning are two completely different things. And most investors don't realize the gap until it's too late. Here's the truth. Tax filing is backward looking. It records what already happens, planning what should happen, but before December 31st. We can only decide before December 31st what happens in March or April when we file taxes. And real estate is not forgiven when you skip the planning part. Let me give you real examples. I see investors buy a property in November or December and assume they will get this massive write-off, but nobody helped them plan timing, cost segregation, bonus depreciation phase-outs, income coordination with their spouse, or passive loss limitations, so they can close excited and then find out the deduction doesn't even offset their income. That's not a tax problem. That's a planning problem. And here's another one. Someone qualifies for real estate professional status on paper, but they didn't properly group activities or document hours throughout the year. Now they're sitting on losses they thought would wipe out their W-2 income, but unfortunately they can't use them. Again, not a filing issue, a planning issue. So here's a big one. Cost segregation studies done without long-term modeling. Yes, you get a big deduction upfront, but nobody explains your depreciation recapture when you sell. Nobody modeled what happens if tax rate changes. Nobody asked about your 3-year or 5-year exit strategy. Strategy, tax planning, reducing taxes is not only about this year. It's about the lifetime of the investment. And this one hurts the most. Selling a rental and calling your CPA after you already accepted the offer. At that point, your options are really limited. 1031 exchange requires preparation. Installment sales require structuring. Even timing the closing date can matter. By the time the contract is signed, most of the strategy window is closed. Here's what I want you to really hear. If you're building wealth through real estate, taxes are not just compliance. They are one of your biggest expenses. And the difference between reactive filing and proactive planning can easily be 5 figures per year. You didn't get into real estate to build wealth for the IRS, I can assume. You got into this for freedom, for leverage, for options. So here's how you know you might be in the filing only category instead of real planning. If your CPA only talks to you in March or April, that's filing. If no one is projecting your income before year end, like for example now for 2026, now the end of February, beginning of March, we're projecting your income for 2026. If you're not doing it, it's filing. If you've never seen a side-by-side scenario comparison before buying or selling, that's filing. If you don't know your expected tax bill until the return is done in March or April, that's filing. Planning sounds very different. Planning sounds like if we buy this now versus January, here's the difference. Planning sounds like if your spouse qualifies for rep status, and we group these activities, here's what that unlocks. Planning sounds like if you sell in 2 years instead of this year, here is what happens. That's the strategy. Now, I created something for you because I don't want this to just be theory. I put together a real estate tax planning self-assessment checklist. It's simple, but it will help you see very clearly whether you are actually planning or just filing. Even if you're watching this live or replay, comment the word plan and we will send it to you. And here's the important part. If you go through that checklist and realize you have missed things in the past, that doesn't mean you have failed. It just means no one showed you how to think ahead. And that's fixable. Real estate is one of the most powerful wealth building tools out there. But without proactive tax strategy, you are leaving money on the table every single year. And small leaks sink big ships. So if you're serious about building real wealth through real estate, start treating tax planning like part of the investment strategy, not an afterthought once the deal is done. Come and plan, grab the checklist, and take 10 minutes to see where you stand today. Because once you see the gaps, you can close them. And that's when real tax savings actually begin. That's it for today. Share it with a fellow real estate owner if you think they can benefit, and they will be thankful to you. And bye for now. Till next week, we'll talk more about real estate again.